The 7070 thrust indicator, something we don't see very often, has just happened, and it's got all traders and investors like you and I very interested. What does it mean though for us moving forward? Well, in today's video, we'll take a look at the data together, along with what's going on in the bonds market after the events of the weekend. An inversion of the 30-year yield versus the 2, and it looks like things are starting to drop off a cliff. So what does this really mean for us moving forward, and could it be an impending recession indicator? In today's video, we'll break that down along with the breadth that just continues to improve. And of course, our big call on crypto seems to be coming true. We've probably just seen the low and it looks like things are just heating up. Join us as we go through stocks, commodities, and cryptos together right now. Well, welcome back everybody to The Daily Show. My name's Tom. Today we're discussing everything from the macro to the data to the lead indicators of what we need to be watching on markets. And it was a pretty good day if you are a bull in markets. Breadth was improving, and of course, realistically, it was great to see the banks doing so well in the beginning of earnings season. No surprises there. We'll go through Goldman Sachs a little bit later on, but really it was the flows and the retail flows that we need to talk about in today's video. Remember to subscribe if it's your first time here and smash the bell icon if you want to understand a little bit more about how the options market and of course these retail flows end up affecting everything we do. So let's discuss retail flows to start off with. A phenomenon that really peaks around the start of July tends to be that retail traders are realistically trading more into these events. We've seen this really start up heavily, I would say, since 2020, which has meant many of us did come into this market. People before that, you were used to a little bit more boring market, especially during 2015, 16, and those other periods. So let's talk about it. 2023, a huge peak. Obviously, several times in the past, we've also seen peaks around this point. And what it tends to lead into is a sucking into the most important 2 weeks of the year, which we know is the first half of July. And then sometimes during the Q2 earnings, we tend to see maybe a little bit of weakness. Now that's leading into realistically the worst period of the year. We already know that between August and realistically October is usually when we get that secondary pullback in markets. And it still is possible, even though the data does present fairly favorably, which we'll look at in a moment. Let's talk about how good the last couple of days have been. You'll notice here Grant Hawkridge's chart over on X basically shows that over the last 10 days, 896 new highs were made, new lows 26. That is a huge read across the board for the S&P 1500. That shows a broad-based recovery. Now, it might be a little bit difficult to see this particular chart, but you may notice that everything's pretty much green. And what it's showing us is rotation, rotation, rotation. And more importantly, it seems to be coming out of technology, which is slightly weakening, everything we expected, and it's going into some of the other sectors. Financials doing incredibly well, basic materials doing incredibly well, which we expect, and of course things like gold as well, absolutely flying through. And it is a broad-based recovery. This is a good sign for the new highs coming into the market, and it's given us something that we don't see that often, which is a 70 bull thrust. Now, when we tend to see these reads, you can kind of see what the history tells us about these. They tend to be starts of decent runs, and they're not often found right at the peaks of markets. They might be found near the peak later on, but they're not right at the peak. So pullbacks, again, if they do happen, let's say over the next couple of months, they could be very favorable to many players out there. And this is why, if you have a look at the next 252 days, again, there's a lot of reads here, so we have a lot of data, you'll notice that it does tend to be favorable. 95.6% positive return to a median average return of, yes, you know, big numbers, 19.4%. And this is actually very symptomatic of late cycle style investing. These huge returns on markets. Remember, if you look through really big history of markets, you'll notice that we earn between 7.5% to maybe 9.5% from the S&P 500. Around there is pretty normal per year. When you're getting these double-digit gains on top of each other, not so much 22 to 23 or even 23 to 24, that doesn't matter too much because that's a recovery of the 22 crash, but it's the ones after that that matter the most, because when you get those unrealistically large gains, you know that you're starting to get near the end. Now, what does it mean for the next 5 days? Well, that was a little bit more shaky, 63.8% in terms of overall bullishness, and you'll notice it can get shaky for the next kind of few weeks, but then it starts to really pick up in terms of overall positive stats. And this is shown here again by Mark Ungewitter, I think it is, over on X, showing another type of thrust, which obviously is very similar in terms of the 70 thrust. And again, the next 21 days is usually where you'll see any type of weakness if it is to occur. Now, this is a very bullish sign for market traders, but we also want to just have a look and see whether it makes sense across the board and whether it also comes with what we expect, which is a slowdown in the top 10 stocks. And this chart from Optima definitely shows that. Market cap 10th decile here, 0.82 down average. That's the big stocks. They're not doing so well. But a breakout of the equal weight, which we talked about on the weekend video, RSP, has us thinking, okay, this is a broad-based recovery, mostly thanks to the odds now going to like 95% that we'll get a September rate cut. Now, a lot of this is also due to the Republican wave that's now expected in the markets, or at least that's what the market polls are predicting. And this means that there's going to be a lot more expenditure in certain areas, and the Fed may have to actually rate cut in some ways to just pay for its own debt that's going to be written into the markets. Of course, they don't want to keep plugging the treasury market, and this is something that Wall Street is already starting to price in. Russell 3000 breadth also looking incredibly good. One of the best thrusts we've seen in some time, and probably the best thrust we've had since December of 2023. And we all know how that worked out. It ended up causing a couple of little dips, but in general, a fairly good run. So again, it's kind of pointing towards if we do end up getting dips for whatever reason, as long as they're not significantly or massively serious, that this market could have some more to run. Let's break down Goldman Sachs earnings report. It was pretty good across the board, and you can see here they had a strong Q2 with 10.9% return on equity and 12.8% for the first half. Also, you can see here record financing revenues and assets under supervision. So it's pretty good for the banks. Nothing realistically changes here. Optimistic on US outlook on AI-driven opportunities. They're still dumping into it. And really, I would like to summarize this report where we created lots of debt and we're doing really well. And that's what the banks are doing right now. They're creating lots of debt, and effectively this will eventually bite us all. But we all know that creating debt means that we can all live our lives for a little bit longer, and this creates that late cycle phenomenon. And banks are being rewarded big time. We saw this in the UK as well. All the banks that lent heaps of money, their stock price was flying. All the ones that weren't lending money, we didn't really care about them too much. And this is the kind of thing, especially with deregulation, that's leading these things like regional banks to go up. And there are many regional banks that are very questionable. So, of course, that will be the story that we all have to be watching over the next 2 years. If the banks start struggling, it's not good. Anyway, Goldman Sachs are seeing no stress on their overall output here. You can see this one from Mike Zaccardi over on X, and it says no stress from Bank of America. And their report basically says that overall they think everything is all good. And you can pause the video here if you want to read through it. All right, let's have a talk about the yield, because this is the story that a lot of people are concerned about. What about the US 2-year versus 30-year? When we get uninversion of yield curve, does that mean instantaneous crash? Well, firstly, the US 2 and 30-year have never been a very good read. Remember, it's uninverted several times already, and I think that's very important to state. And we're really looking for the 3-month and the 2-year to uninvert with this 10-year to really get things started. Now, I thought this was a great share. You can go and check it out over on our X account if you want to have a copy of it. And basically, it shows here what's happening. The days inverted overall, obviously, we're at a significant period at 557 days inverted. And we expect that eventually will uninvert, and that usually causes a recession. Now, this indicator is pretty good. It's got a great track record with it. But I think people are probably getting ahead of themselves thinking that the market's just going to uninvert and it's all going to crash. That's actually not usually what happens. It can be, but it's generally not what happens. You'll notice here another share over on our X if you want to check it out. Again, Ritz Holtz Wealth Management put this one together, that there are many different reads we've had in history. Some of them have come off, of course, no recession when we got cuts. Generally speaking, when we have uninversion of yield curves, though, we do end up, as you can see here, because this is after first rate cuts, we do end up in a recession a lot of those times, as you'll be able to go through the stats. But some of them go ballistically higher before something goes wrong. So it's going to be understanding the overall sectors inside the market and following the flows of some of the hidden sectors that most retail traders like you and I don't look at that will be most important. And I doubt the signs will be in your favorite stock. They're probably going to be in something you barely look at, and that's what you're actually going to be needing to do as an undercurrent kind of risk assessment. We'll show you one of the ones we're looking at later on today's video. So let's break down the S&P 500. Here's a great chart, again, Grant Hawkridge, and it shows you here that extreme bullish readings are coming through. Now, we know that the first 2 weeks of July is pretty good. We're coming to an end of that now, and basically that was exactly what we expected. Now we're in the week of OPEX though, and of course there are some stats around specifically the NASDAQ around this time that can show slowdown in the NASDAQ and speed up in the rotation of the market. So while we're now down in this line, you start to think, well, maybe we're in extreme bullish readings. We need to just pay attention here because this can be where we start to have a little bit of problems. Now, here's a good one from Jeffrey Hirsch, and basically it shows that since 1982, the NASDAQ has been down 26 of 42 weeks. So that basically means this is a negative overall week for the NASDAQ, and it's been down 6 straight during July. So basically, we know that the NASDAQ has struggled in recent years. You can see kind of here the struggling that's overall occurred, and that may be set to continue as we see rotation out of semiconductors, which we expect, and rotation into the rest of the market. It's kind of like saying we've got a pullback in time of the NASDAQ. That is, it's having a breather. The rest of the market's catching up, which is perfectly healthy. And then, of course, we hope to see an explosion of the big tech stocks back out again. This is kind of consistent with Wayne's data as well. Wayne showing us that overall we should be bullish on the longer term. That is the next kind of maybe hundreds of days, 200-300 days, but that there could be some little problems over the next week in particular. And that's something I think that's worthwhile paying attention to. Earnings announcements this week. Most people's eyes are on the banks, but they seem to be doing pretty nice. As we saw, Goldman Sachs has done well, and we've got a few more banks coming through. And then the question becomes Netflix and TSM. So of course, a semiconductor and one of the big tech companies. Now, Netflix is trading right at the high, and TSM has been going absolutely ballistic recently. And we have to expect very large moves. And of course, the options market is expecting plus minus 9% on Netflix across the board, and TSM will also be wild. So Thursday is the day this week that you need to be paying attention to, and that could get this started as well, which is the VIX futures term structure. Basically, it's showing us that volatility is set to expand into August, September, and October ahead of the election. Now, it'll be interesting to see an update on this post, of course, the events of the weekend, and we will get one of those so we can have a look at it. But overall, this is basically saying that it will be volatile. You can usually expect 2 pullbacks. We're not expecting a crash this year. We've already talked about that several times. At best, you're kind of looking at about a 5 to 10% pullback twice a year. We've had one of those. We usually expect a second one in this next kind of 3-month period. And we'll be on the outlook for it, although still the price action is bullish. Now, where are some other opportunities? We've talked about junior miners versus gold ratio, very strong. The history of gold cycles, of course, overall incredibly strong for the markets. And gold to silver ratio also pointing to possibly silver now starting to play catch up to gold, which it hasn't done. Overall, secular bull markets, guys, they're looking pretty good. We put this chart in every day. I just want to kind of point out, a lot of people in the comment section say, oh, Tom, so bearish, man. Not bearish. I think this market's got more to go. I just think you really need to realize that this is late cycle investing, and therefore you must be, keeping your FOMO in check. That doesn't mean you go out and, go buy leverage. I think leverage is the most dangerous thing over the next 2 years. But if you're just trading leverage, sure. But if you get stuck, you could be getting stuck for a very long time. So it's not like at the beginning after a crash anymore. It's not even like the middle way. History would tell you that we are in the bottom, the last kind of innings of this particular bull market. And it doesn't matter who's in power, really. It's already set in stone due to the types of deregulation that are occurring and, of course, the types of debts that are being written. I think most people can probably agree on that, but I just want to kind of share that because it is very important that you've got your investing mindset and your trading mindset. They're different things, and I understand we have a lot of investors and traders here in the market, but remember, they're different concepts. Now let's have a look at how things have performed since the last 5 days. So we saw KRE really doing well. PBW I expect to weaken off a bit as with solar. Just basically the Republican red wave concept may be a little bit negative towards those particular stocks. And we have some nice pickups in biotech. Of course, home builders doing amazingly. And again, the slowdown in semiconductors and tech, exactly what we've expected. Last 24 hours, great to see energy stocks blowing up. This is exactly what we expected as well on the weekend. Metals also there, fantastic. And of course, banks as well. That's all a good sign for the breadth of the market. And you don't really want to see defensives doing amazingly well, which they weren't. We saw things like staples and basically healthcare does not do that well. All right, let's jump on over to the market. So the market, the S&P 500 is giving us taglines of saying, well, that was a great 2-week run. Maybe now we're just going to have a chill. And of course, signs such as this star here, they usually point to either little pullbacks in markets or sideways action. Is that a guarantee? No, it's only one read. And of course, price action wise, we do not have a significant negative effect. Did we make a new low? Absolutely not. Have we pushed towards the 5,700? Sure. But you'll notice that exuberism, like everything that went through when we were doing our live stream we do every Monday, I just mentioned it straight away. It's the Russell 2K. That's all people care about right now. The money flow is there. In fact, I had a chart ready for today's video. It just shows that they just packed it. They smashed the flow into the Russell 2000 and funnily enough into crypto over the last couple of days, which we'll talk about soon. So yeah, SPX, I expect it to kind of be sideways. Let's have a look at the futures market. You can see here, still, of course, bullish. Some reads saying that it's a little bit overly extended, and there's a couple of wicks up here. So it kind of looks like what I would say is a melt up. Do I short that? No. Do I long that? Yeah, if I'm long it, I'll probably just hold my position. Would I re-long? Well, you just have to see good areas. And I think when you look at the daily here, and even the smaller time frames, you'll notice it's just making a series of higher highs and higher lows. It held that defensive 55.76 level. This is the one-day expected options moves. And for now, it's really just look at the options. We know 5,600 at the moment has all the puts on it for the next day of trade. Then they kind of disappear a little bit leading into the end of the OPEX week. And we also know that we're kind of struggling between positive and negative gamma. You'd almost say it's neutral right now. If the market pushes above levels such as 56.50 and then really starts to get running, then that of course should push a 5,700 number and move fully positive gamma as dealers have to hedge their positions off because they'll be offside. But yeah, I would say that the market looks like it's sideways on the S&P, and that's exactly what we kind of mentioned. And you know what? Yeah, it was up a little bit, but really it was Russell all day on Monday. S&P versus CTAs, you can see here they started to up it a little bit. NASDAQ also, I would say, neutral up. And copper dropped a little bit here. So as we've seen, copper has been weak over the last couple of trade days. We're looking for strength in the price action there, and we'll show you the level in a moment. Gold still doing really well, loving that, looking for a breakout. And Brent, certainly a slowdown, although energy stocks actually showed some significant improvement. Remember, they've been lagging oil price heavily over the last kind of 2 to 3 weeks. What about Tesla? Through 250, of course, Elon Musk instantly endorsed Donald Trump. A lot of things going on. People may see this as a pretty good red wave style stock now in some ways. And it's, of course, the AI component as well that I think is pretty key. And realistically here, it doesn't really matter what you think. It's more about the options. And that's what we've really shown you. Price action and options over the last couple of weeks. That helped us to get that big 30+% move. 250 plus hold. That's going to be strong. Why? Huge amounts of options. Positive gamma. So we are positive gamma on Tesla. Wasn't a great hold through the session. Love to see a break of the last session high. That would be significant. I think that would really start the flows coming in. So watch that space. NVIDIA, on the other hand, when we have a look at this chart, you'll notice that we're still stuck within the zone, and we expect this to still be sideways for a bit. Stuck between 115 and about 140. So that's kind of where the main options are. For things to get really up and crazy, it's going to need to get past 135. You'll see that's the major call strike this week, where a lot of positive gamma could be coming into the markets. Just a reminder, of course, some bullish action coming from Tesla. 9 consecutive days up on Tesla, giving an absolute return of some pretty positive over the next 21 days, which also helps when you're looking at your price action and your options flow. So this happened last week, and that's what usually happens next in terms of the overall gain structure. All right, let's jump into the charts and we'll go through the bonds indicators first. Pretty good on HYG, showing no real signs of serious concern. And my own bond indicator here also showing signs of no serious concern. So basically the bonds are looking all right at this stage. US versus 2-year versus 10-year, starting to get down closer to uninversion. Of course, always have this alert here. And as I mentioned before, although people are making a big deal out of the US 2 versus 30, it could be the beginning, but really the ones that matter are the short yield with the 10. So that's the two that you still need to be looking at, 3-month and 2-year. Don't worry about it. Don't get scared of that one. Get scared more of the 2-year and the 3-month. And even then, as we show in the data, you don't get scared straight away, guys. Everyone on the internet is going to be saying it's broken. That's exactly what you want everyone to be saying. Doesn't work, it's broken, it's a crap indicator, blah, blah, blah. That's exactly what we want to see. If that happens, even stronger towards why you should be terrified of an uninversion of the yield curve. And this time around, it's totally different to normal because of course, the things that we discussed before. All right, let's talk about treasuries. A lot of people trying to buy this thing as a trade. I wouldn't suggest that. You know, treasuries is a multi-month, if not year investment strategy. They are bonds. They are not worth trading, in my opinion. And we've talked a lot about this level here, 89. And of course, anything in here eventually being good. And of course, my supercritical zone remains at 110. So I think it'll get to 110, but it's not going to be quick. Let's move over to ITB. Home builders doing well. KRE doing well. Very good for the markets. Obviously a bullish sign. Copper holding its own over the last 24 hours. What we'll need to see is this thing break 470 to really get going on, but it's still holding in a bullish overall price action trend. So that's key. And US dollar is finding some buying pressure at its absolute critical point. But if you had to ask me, I'd say this is more bearish than bullish now. And I'd be looking at pullbacks to be met by bear demand. Basically, the US dollar should be expected to weaken, especially in light of now pretty much forcing in a lot of rate cuts. Let's move over to gold. Looking pretty good, looking maybe ready to set a new all-time high. Obviously quite strong up here. I do expect pullbacks to be met by bull demand. Gold has a lot of things going for it, and it really wins in both stagnation and cutting yield environments. US oil, not the best on the charts. Would have liked to see this one find a buyer over the last 24 hours. Still holding that key zone we talked about, and we need to see it through 83.70. If it does that, it's going to go ballistic. And that, of course, will bring this stock market even further along, the sector of XLE. Now, XLE was up regardless because it's playing catch up to where oil already has been recovering to. I think it's a pretty strong move from XLE, not a close above 92, which I would have liked to see. But as we suspected, we talked about this for a few days, not bad little run here. One of the best sectors of the last 24 hours. I'm pretty keen on XLE, so I'd like to see that works out pretty well from risk reward. Tesla, not a good close. Of course, looks like a shooting star. You want to get a high, 265 plus close, significant. Stats are in the favor. Tesla's just doing its thing. And this would be a zone I would watch very closely. I just wanted to kind of reiterate a few things. We spoke about this on our live stream. I put it in our Market Masters Club. Oh, when did we get in? It was a little while ago now, so it was over here, May. So basically, this has been an incredibly good run, in my opinion. Very replicable hood. It does look like it's breaking out to a new high here. You can see on the weekly and the daily some nice breakouts. Helped in part by crypto, also helped in part by the elections and everything else that's happening. And yeah, it seems to be very, very strong. So overall, a nice replicable trade. Does look like it's got pretty decent blue sky on the horizon here in terms of there's not much action between kind of 24 and even up to 30. So hood, certainly quite a bullish trend. And I just want to kind of reiterate that because it's, again, another replication trade that we have in our courses. If you're ever interested, check out the links in the description, fxevolution.com. That is certainly one that we can replicate several times over on blue chip style stocks. It's a good style of position. All right, let's move over to Nvidia. And as we suspected, this is continuing to struggle. And that's nothing bad. Remember, if you're bullish on AI, as you probably should be, we're in a bubble. We expect it to do better. And at the moment, it's having a chill. This is what AI does. Look at semiconductors versus SPY. We've put it in all of our previous videos. You can check it out. Now we move over to the strong one, which is the US 2K. Very good breakout in the weekend. Love this thing. Talked about it a lot. Continue to love it. And of course, we're looking for this to move into 2250 over the next coming weeks. And it looks like it wants to do it. Pullbacks, we think, will be met by bull demand, and it's very, very strong. It's driven in part by regional banks, which of course are improving. And you can see here, in comparison, the Qs are just not doing as well. Again, going sideways, it's what you would expect. Sideways action on the Qs, increase in breadth, the market flows goes through to all of those weaker sectors that haven't been doing so well. And you can track this a lot of the time by looking at RSP, which had a pretty good last couple of sessions. So again, breadth is improving. Now let's move over to Bitcoin. Incredible good movements here. Love the Bitcoin trade. Been waiting for it. We posted over on X several times. We basically posted, get this, go here, achieved. Do we think now that it's going to go even stronger? Yeah, I do. I feel like that's the low put in on Bitcoin. I said that in the last live session as well. And I think a lot of people are caught off guard here. I heard short squeezed, got absolutely smashed. Shorters got smashed, guys, on Bitcoin. Absolutely crippled. And it's to be expected. People are going to short this tweezer every time and they're going to get smoked. And that was what we suspected. It did occur. The market's gone bullish. And now I think pullback should be met by bull demand. So this is a great sign for crypto traders. You could claim it's thanks to Trump or whatever else, but really I think it's just price action coming through. Ethereum, another good movement. I prefer Bitcoin myself, but again, putting pressure on this high-end line here, which you'll notice is at 35.30. So nice bullish action on Ethereum. I prefer Bitcoin. Bitcoin usually leads, then the rest come through. For the news for the week ahead, guys, not too much to go through. Basically, it's earnings week, as we know. Look at Netflix, look at TSM, and there's a little bit of data coming out from CPI on Tuesday for the CAD. As always, if you enjoyed today's video, make sure to sign up for our other things down below. Follow us on X. Also check out anything else we're doing. And if you're interested in any of our courses, you can find them over on our website. Thanks so much, guys. Have a great day and good luck out there. I hope you've been doing well recently. It's been some amazing trades. I will say the market has not disappointed recently.